I think it is clear to believe in the power of ideas.
Fresh thinking to the Manhattan Institute.
Okay, good morning, everyone. So our last panel was certainly very interesting, a very lively discussion. So we're going to follow on now with talking about the role of proxy advisory firms. And a couple of things. Brandon and Professor Jackson had talked about how votes in the 1980s, how that type of voting and proposals that came up at that time and the vote results on those have changed dramatically over the past 20, 25 years. And I was wondering, Gary has been working in the proxy solicitation business for many years, and I was wondering, Gary, if you could give us some color on your take on how you see the landscape on proxy voting and that type of picture, how that has changed going back a decade or 15 years.
Sure, I'd love to do that, Peggy. And I think it's probative to go back to the 80s because I think the pendulum was really way to the left at that time, and it's really swung way in the opposite direction today. And there's a number of reasons that's happened, and I'd just like to go through some of the key events that may have taken place over that period to impact that. I think back in the 80s, what was once considered a routine annual meeting from a corporate perspective are now, in many cases, high anxiety events. So I think in current time, we have clients that call us 6 months in advance of their annual meeting to discuss some proxy issues that they have. Nothing is routine today, and that's because the landscape's changed. And what has changed? So from the 1980s on, in 1987, I have some statistics that state that of Russell 1000 companies, 40% of the ownership was held by institutional shareholders, whereas if you roll forward to current time, about 80% of corporations are owned by institutional shareholders. So there's been a lot of shift to transfer of power away from individual shareholders to institutional shareholders. Back in the 80s, the father of the corporate gadflies were the Gilbert brothers and Evelyn Davis and Chevedden and church groups. Those were the people that submitted most of the proposals for annual meetings. And at that time, corporations were more focused on whether or not that shareholder proposal would receive the minimum vote required to get put on the ballot the next year. That's the 3-6-10 rule that we discussed earlier. So, after the third year, if a proposal didn't receive more than 10% of the shares voted in favor of it, the proposal got kicked out. So our clients would come to us and say, you think there's a chance that's going to pass? Well, in current time, there's no question that that would pass, that most proposals would pass. I think in current time, we're in an environment where corporations are more concerned with whether or not a proposal is going to carry. Is it going to receive more favorable votes than against votes based on shares voting or based on the outstanding shares? Another thing that took place back in the late 80s is in 1985, ISS was founded by Robert Monks to provide proxy research to institutional shareholders. As we roll forward into the 80s, in 1988, there was I think we'd call it a landmark instance that took place. The Department of Labor issued the so-called Avon letter, and most of you are probably familiar with that, but the Avon letter really put public pension managers on notice that proxy voting should be taken seriously, and it's a fiduciary duty of theirs to vote proxies. And in 1994, the Department of Labor updated the Avon letter in a bulletin stating that the Department of Labor now advocates a corporate activist role for pension plan trustees to include activities intended to monitor or influence corporate management. Now, that's a mouthful. In 2003, the SEC had an interpretive bulletin providing proxy voting by investment advisors. They required investment advisors that exercise voting authority over a client's proxies to adopt policies and procedures reasonably designed to ensure that the advisor votes proxies in the best interest of their clients. It also required them to disclose to clients information about those policies and procedures, and to disclose to clients how they may obtain information on how the advisor has voted the proxies. Finally, it indicated that the investment advisors could discharge their duty to vote proxies and demonstrate that their vote was not a product of conflict of interest if they voted client securities in accordance with predetermined policy and based on the recommendations of an independent third party, for example, a proxy advisory firm. So now this whole proxy voting is being outsourced, and I think in today's day, I think we know, Jim had mentioned that perhaps 15 or 20% of proxy voting outcomes are determined by a proxy advisory's recommendation.
So you mean to say then that the role of the proxy advisory firms has changed dramatically over the past decade or so?
It certainly has, and one of the reasons is, you know, the Department of Labor and the SEC has really put a burden on institutional shareholders to be diligent in voting their shares. Now, we speak to institutional shareholders all the time. Some institutions have 5 or 6 or 7 or 10 individuals that vote proxies for about 8,000 annual meetings a year, and to look at every proxy and look at each issue and vote on 8,000 meetings in a year, if you've got less than a dozen individuals doing that, forms a burden on these institutions.
Especially smaller institutions.
Especially smaller institutions. A lot of the larger institutions, Fidelity, for example, as Bob knows, and you know, Wellington Management and Vanguard and BlackRock Group, they've got a pretty big staff to vote proxies, and they like to do a lot of their proxy voting in-house. They do subscribe to third-party services to do research for them. But many of the smaller institutional shareholders outsource the proxy voting function, and you know, often I'll call an institution, they'll say, well, don't call me, call ISS, they vote our proxies for us, or call Glass Lewis, they vote our proxies for us.
So let me just interrupt you for a second. I just want to go to our 2 representatives from the proxy advisory firm. So Bob, if you could just give us some kind of a flavor for how Glass Lewis comes up with its voting policies and guidelines, and how do you go about coming up with those recommendations? And do you talk to institutions? Do you talk to issuers? And how do you come up with how you would work around, you know, coming up with the vote recommendations on various types of proposals?
Sure. Well, I think maybe just very instructive, given my experience, having been doing proxy voting for 16 years, God help me, seeing what I've seen in the sort of progression, what used to happen is institutions just would not vote, and then they would just vote with management, and then they would hire a proxy advisor, and now we're at the stage that most of them are, most of the largest investors that control certainly the lion's share of the votes are using proxy advisors as one input into overall voting. If you look at the top 20 mutual fund complexes in the country, which I haven't done the math, we have institutes for that, but I think if you look at the amount of assets they control, that is definitely by far the lion's share of the assets being voted in this country. Now, the way we've come up with policies at Glass Lewis, we try not to act in a vacuum. We recognize there's lots of different perspectives on really many different issues. So we really look at each market individually, but I'll focus on the U.S. So we look at developments in the U.S., and the U.S. is probably the most developed in this sphere in the world in terms of disclosure, in terms of history, in terms of shareholder activism, in terms of academic studies. So we look at all those sort of aspects that may impact the relevant issues. So we'll look at academic studies. We rely on Professor Jackson and Lucian Bebchuk, as well as countervailing arguments. If you look at an issue like independent chairman, we recognize that the academic evidence is really all over the map. So we examine all those in detail, and we discuss those in our policies and in each proposal. We'll have discussions with a lot of companies. Part of my role as Chief Policy Officer, engage quite frequently with a lot of companies, and we do this really probably with at least 500 or so companies every year across the globe in our different offices.
So you have your stated policies, and then you sometimes would deviate from those policies? You would engage with companies, or how does that work?
Well, that's how we develop our policies.
Oh, okay.
And the policies themselves are really designed to allow for discretion to be applied because we think that's absolutely essential. We try not to be too black and white on any issue because we think as an investor look at these sorts of issues on a case-by-case basis, then when you make a proxy voting decision, you should simply do so. So I don't like to say we're deviating from a policy necessarily.
Right.
I think it's more appropriate to say we're applying our discretion for a particular issue within the bounds of our guidelines.
I see. Okay. Yeah, because Jim's research had indicated that ISS's vote recommendations seem to be out of whack with the way institutions are voting. So we were wondering, how does Glass Lewis reconcile with that? I mean, do you look at how institutions vote and how take that into account when you're coming up with your guidelines, and how? Do you say to yourself, well, it looks like the majority of institutions are not supporting these types of proposals. Why is that? Should we be thinking about that? And maybe should we, adopt a different take than ISS has on this? Well,
far be it for me to defend my esteemed competitor who's not here to defend themselves.
They were invited, by the way. I want to make that clear.
Well, I guess, on one hand, it seems like, they're controlling, purportedly controlling a certain percentage of the votes. On the other hand, their vote recommendations aren't matching up with the results. So I'm having a little trouble reconciling those two aspects of it. But what I think is relevant is that when we look at an issue, if if it's not getting much support, there's probably a reason for that. So when we look at the results of a vote, particularly on a share proposal, if we see very little support, we recognize that there's probably not a lot that company needs to do. But if we do see a proposal, we were using the figure of 20%. But if you see a proposal that gets 25, 30%, 40% support from a shareholder, and the company doesn't seem to make a response to that, or the response seems quite limited, then that's something that we think may be of concern for shareholders as to, is the board really addressing these issues? So while we think it's certainly relevant to look at the vote results, because it's one aspect of the overall market in terms of how they're viewing these issues. But our clients really ran the gamut from the largest investors in the world to the small hedge funds that frankly registered under the 40 Act for good client purposes, at least from their perspective. So they have very different perspectives, even on an issue like majority voting or independent chairman. So we don't poll our clients. We don't necessarily feel we're sort of going to be regurgitating back to them what they already think. Our role is an independent provider to empower them to make voting decisions. And part of that does mean that we engage, of course, a lot with our clients to get a sense of what they look at. But they may be all over the map on the same issue, so we can't rely solely on their perspective, and nor do they want us to.
Jim, did you want to say something?
Sure. Just briefly, in terms of, because it does sound, they're saying on the one hand this, on the other hand the other. In other words, on the one hand, there's a big disconnect between ISS recommendations, and we're not specifically speaking about Glass Lewis. We've only tested ISS, and proposals to get a majority of support from shareholders. And then on the other hand, we're saying what ISS influences a lot of the market. And the reason for that is kind of what Bob, I think, was alluding to. I think we kind of agree here to some degree. I mean, what we're talking about, ISS only has a binary recommendation, right? They're either for or against a proposal. And then what we're testing that against is whether a majority of shareholders are for the proposal or a majority of shareholders are against the proposal. And in a lot of areas, there's a significant disconnect there. In other words, ISS is backing them 96% of the time, and one of them passes. That's cumulative voting, for instance. 96% of the time ISS supports cumulative voting. Only one proposal is passed for cumulative voting at the Fortune 250 dating back to 2006. So there can be a substantial disconnect here. That doesn't mean, however, that ISS doesn't matter. ISS has a big influence, as does Glass Lewis, probably not quite as big because its market share is not as big. But ISS has a big influence, and we calculated out as about the equivalent of a 15% owner in the market. Now, we don't have a variable in there for Glass Lewis, and if you started controlling for Glass Lewis and the interaction effects there, or EganJones, it might change that percentage somehow, but clearly there's strong statistical significance that ISS acts like a large owner in the market voting a block of shares. So what that tells us is that there's really a bifurcated market here, as Bob was describing. The largest institutional investors do develop their own policies, do have pretty significant teams of people. Places like Fidelity and Vanguard, they subscribe to proxy advisory firms' reports a lot of the times, but they're not following them, and they may depart often, if not consistently, on various questions. There are other smaller institutional investors, however, who find that they get no competitive advantage whatsoever, I would argue, from being a more informed voter on thousands upon thousands of votes across their portfolio. They're not going to get a competitive advantage over other funds in terms of how they invest their money, and yet they're forced by the government to cast a vote. And the way they can discharge that and cover themselves in terms of their fiduciary obligations is effectively to outsource it to a proxy advisor. And that's why we see that disconnect. And so what that means is, on the margin, if it starts getting close, ISS recommendations, and probably other proxy advisory firms as well, can push those votes into a majority situation where, even though it's a non-binding vote, it becomes very, very difficult for the board to walk away. And it can become somewhat of a self-fulfilling prophecy, even on these questions where, 25, 30% of shareholders are taking issue with something and the board's not responding. Well, if those 25, 30% of them, if 75, 80% of that vote is explained by this block vote from the proxy advisory firm, then effectively you have a sort of circular argument where the proxy advisory firm is saying, we think you should vote this way. A block of shareholders follows them. Oh, and if you don't respond to what we're saying, we're going to hold that against you in the future. So that's the sort of dynamic we're talking about here. And I don't think it's inconsistent, although I see how on the surface level it can seem that way.
I think the evidence is actually difficult to determine specifically because, first of all, you only have two options, vote for or against. And there's lots of reasons why a recommendation may match someone's vote. But ultimately, unless you're inside the head of the investor, you have no idea if that recommendation is influencing them, are they following them completely? And don't get me wrong, there's certainly a number of smaller investors who do tend to follow their recommendations. Usually that's done after they review Ken's policies, my policies, ISS's policies, after making an informed decision. Now, just as they outsource lots of aspects of their investment portfolio, including the investment decision-making, they may look to an outside source to help them make proxy voting decisions. So I think, it's one thing to point out that there may be some influence. I think it's impossible to determine for sure, this is my main point, it's impossible to determine for sure what that influence is without going inside the head of the investors.
I don't disagree with that. I mean, we don't know the exact motivation, but the best way we can do that is empirically. And so we don't take it as a binary in terms of the way we do this empirical work. We take it as a percentage vote, and then we correlate that across various factors. So we end up, the way regression analysis would normally be done. And when you're talking about hundreds of companies, thousands of votes across multiple years, controlling for various factors, and you wind up with a coefficient of 15, which is 15 percentage points, and a t-value of over 15, which for stat geeks means, this is just, it's absurdly statistically significant at the 0.0001 type level. Statistical significance, there's clearly a strong effect there, and it's a much statistically stronger and percentage point stronger effect than you see for any other single variable, with the caveat that once you separate out for classes of proposals, while statistically less significant, you do see a stronger percentage effect, for instance, on something like board declassification, which tends to get very high votes.
Thank you. Ken, can you just give us kind of a picture of how EganJones goes through determining their voting policies? Is it different from Glass Lewis, or can you just give us kind of an idea about that?
Yes, I can. At EganJones, we have clients that range from the very largest pension funds to smaller registered investment advisors, and everybody in between. And ordinarily yearly, but certainly to some degree throughout the year, we review the standards we have, and we talk with clients of ours, we talk with issuers, we certainly read a host of academic studies that fall on all sides of all governance issues. And in the end, it isn't a mechanical process. We don't take a vote out from all these sources outside the firm. We make a judgment based on that, with our focus being totally on shareholder value. If something increases long-term shareholder value, we're for it. If in our opinion there isn't a connection that we can determine, And there are on some shareholder proposals, and we feel on others there are not. But in the event that we don't see a connection, then we're less inclined to support it. Our guidelines are guidelines. So when it comes to variance from those, we do that. And in a sense, every recommendation we make is case by case, but we have to have a consistency to what we do,
Right.
and that's represented by our guidelines.
Okay. So you really focus more directly then on shareholder value and not so much on proposals that would have a social or policy
Well,
focus? I mean, you're not going to necessarily
again, though,
support-
if those social and policy-oriented proposals have a positive impact on long-term shareholder value in our view.
What would be a type of proposal that you think would be one that would go toward
Well,
shareholder value?
let's take an historical incident that occurred years ago, the Bhopal incident. Union Carbide, I believe, was the issuer. If there had been a shareholder proposal regarding something concerning the operation of that plant and the way it was run by the company. Now, there's no question to us that this is theoretical, of course, a hypothetical in this case, but we're such an incident had a tremendous effect on shareholder value of that company. That's an extreme example, but there are many examples where things do create or don't impact shareholder value, and that's our key point. That's our key focus.
And Bob, how would Glass Lewis look at that? I mean, how do you focus on social policy type proposals as opposed to those that are directly related to shareholder value, or do you make a distinction?
Yeah, we evaluate each proposal individually. So it could be something that, from a governance standpoint, say you call a special meeting at 10%. Our approach depends on the size of the company, the type of company, the size of its investors, et cetera, a whole host of issues. Same thing with an environmental social proposal. I think sometimes people get bogged down in the semantics of this is just an environmental proposal, this is just a social proposal, and therefore has no relation to the performance of the company. We look at the way the proposal is drafted, what the ask is for, how the company addresses this issue, how its peers have responded, what the disclosure is. So a whole host of issues. So if it's an environmental issue, that's a pretty high bar because we feel that most of those issues are really in the purview of the company. That really goes a lot to the business judgment. But if there's evidence of poor environmental practices, I'll use BP as an example. The disaster in the Gulf was really one episode of a series of episodes that they had, which was evidence of poor environmental practices, some of which were led to from safety lapses. That isn't just an environmental issue. That is an enterprise issue.
Exactly.
So those are the sorts of things we look at as, how does this ultimately affect the company from a financial standpoint?
Because that would have a long-term impact
even if it's
on shareholder
reputational,
value.
you could look at their targets of some of the retail manufacturing of clothing were targeted by some groups given their supply chain and that sort of thing, where they were sourcing some of their clothing manufacturing. Now that is a relatively social issue if you want to put a rubric on it, but if you have people stop buying your clothes because of concerns about using child labor, that ends up being a very financial issue. So all these are aspects of the analysis.
So you have to look down the road.
Absolutely.
Okay. All right. Thank you. Gary, from the company perspective, then, how would the company interact with proxy advisory firms in preparing for what it sees down the road as possibly a negative vote recommendation from a proxy advisory firm? How do they set that up and determine how they'll interact with institutions or with the proxy advisory firm, or how do you work that?
There's a number of things. So what happens is the company has their annual meeting, and the first trigger would be there was a proposal on the annual meeting that didn't fare well. We call it the minority rules. If a say-on-pay proposal didn't garner more than 75 or 80% of the vote, a proxy advisory firm would say, well, there's an issue at that company. So if a company is in a situation where proposals didn't fare well and they know they need to address those for the next annual meeting, they'll start pretty early. The proxy season's in the spring. What we try to tell our clients is let's get on the phone with ISS or Glass Lewis at the end of the summer after everything's cooled off, discuss what the issues are, and we try to educate them on what changes they need to make and what steps they need to take to address the issues in a satisfactory way to their shareholders. And you know, the power that institutions have now in voting proxies and impacting outcomes of votes is just tremendous. So we have clients coming to us now, as I mentioned before, 6 months before an annual meeting. I had a conference call yesterday with a client who has an annual meeting in April, saying we're going to put a compensation proposal on our ballot, an equity plan. Could you help us to see how many shares we could ask for and not get dinged by an advisory firm or get institutional support? So we'll look at their shareholder profile, we'll look at which institutions are in their stock, we'll look at what their voting guidelines are, and then we'll look at what ISS and Glass Lewis is likely to recommend on that proposal. So we do that really early in the process.
And then once the vote recommendation comes out, and you know, say for instance, then they do wind up getting a negative recommendation, what happens then?
Well, that's a great question, Peggy. And you know, we talk about the influence that a proxy advisory firm has, and there's no doubt there is an influence. Is it 5%, 10%, 20%? It doesn't matter. If a proposal carries by 3% and the impact was 5%, that proxy advisory firm affected the outcome of the vote. What we see is once ISS and Glass Lewis release their analysis, we monitor the voting, you know, almost daily as we get closer to the meeting. There'll be a surge in the vote. There'll be a 10 or 15% surge in the vote, and even before we see the analysis, we'll say internally in our shop, we'll say, oh, someone must have come out with a recommendation against this vote, because we see the vote shift
jump.
All of a sudden. There's a big jump, and then it really puts the corporation, if it's unexpected, kind of behind the 8 ball, because now they have to scramble 2 weeks before the meeting to try to track down the analyst at Glass Lewis or ISS and canvass all of their institutional shareholders and address the issues with them and try to get their support.
And so do you engage then? I mean, is there enough time to engage with?
It's difficult to get, once an analysis comes out and an institution casts its vote, in our experience, it's very difficult to get them to change the way they vote the shares. It's early, what we try to encourage our clients to do is engage with institutions the week after they mail their proxy, before any analysis is out, before there's any meaningful voting, to speak to institutions, just to set them up and say, you know, get a place mark on their calendar to say, we've got these proposals on our proxy. We'd like to discuss these with you when you have a chance. And at least it gives the institution some pause before they cast their vote. And if they think there's going to be a problem, if they have questions on a proposal, they'll go back to that person who placed the call to discuss what their issues are.
Okay, thank you. Bob, some of the criticism that's been levied against ISS has been because it's engaged in consulting arrangements with some of its clients, that it has 2 different sides of its operation. It makes vote recommendations, and it also has Chinese wall, supposedly. And on the other side, engages in consulting arrangements with companies beforehand. So, for instance, on an executive compensation plan, it will, engage with the company and recommend how many shares it can ask for safely to get an ISS favorable recommendation, though they don't guarantee that. But I was wondering if Glass Lewis enters into any kind of arrangements with companies on both sides like that.
No, we don't. We're founded with a different business model of only working for institutional investors. So we don't consult for companies, and we don't consult for even shareholder proponents. Our goal is really to empower our investors to make informed voting decisions. Now, most of our clients have their own voting policies. So I think one thing to keep in mind is Gary's absolutely right. Usually, once we or other advisors come out with the recommendations, then the clients who are paying for those for that information will use that in helping to form their voting decisions. Now, I think sometimes that timing is conflated as an automatic following of a recommendation. I mean, if you look at the way most of our clients have their custom policies implemented, or all of our clients have their custom policy implemented, it's through our automatic system. So as soon as our reports get published, all that information gets fed into the voting platform, and that, in effect, triggers the vote on behalf of the client using their custom voting. So just something to keep in mind. I think when we do engage with companies, it's outside the proxy season. What we really try to avoid is sort of stepping to the shoes of our clients or trying to negotiate a compromise, particularly after the company has filed its proxy. Mm-hmm. We really try to focus on what information the company's already publicly provided, and if they want us to consider that information, then to make it public so every shareholder, every group has the benefit of that information. We haven't been empowered by our clients to negotiate a change. So in our meetings with companies, and I said, we do this quite frequently, particularly my role, we basically, try to make it clear that, we're providing our opinion, and what we're really there to do is listen. And we'll provide a perspective on a particular issue. But I'll give you one specific example of where, we found very constructive engagement from companies. Many times over the years, we've heard from companies like, geez, Bob, we recognize your methodology for choosing peers for your pay-performance methodology, but just really doesn't match up with what we're using. And we really took that to heart, and we decided to look for various options, one of which is to use the company-selected peers, and our clients weren't comfortable with that. They had often come up with their own peer groups, as any investor would. So we ultimately partnered with Equilar to come up with a more market-based peer group. So that's, I think, one result of a constructive engagement with companies is certainly don't feel we're in a position to tell them, you must do this, you can't do this, but to learn from them, and that allows us to hone and refine our processes over the years.
Okay, thank you. And Kent, how would EganJones handle that? I mean, are you independent of companies then, or how do you work on a consulting arrangement?
Yes, we are. We are independent and have been since we were founded. As a matter of principle, we deal with public information furnished by the issuers, and we encourage issuers and their representatives, because most of the proxy solicitation firms are clients of ours also. We encourage them to make public disclosure of matters rather than send private presentations to us. We like it when we see their presentations on Edgar. We view the whole process as one in which we're ultimately going to make a judgment based on our voting guidelines of what's going to drive shareholder value. And clients, of course, in some cases may differ. Our research, the clients who just subscribe to our research and not to our voting may, in fact, disagree with something we recommend, but we have a very high rate of retention, so we read that as meaning that in most cases there's agreement.
Okay.
Does that answer your
just
question?
wanted to ask both of you, we had quite a discussion about the political spending disclosure. What is your policy on that type of proposal as opposed to lobbying, or do you make a differentiation to both of you, Kent and Bob? How do you view political spending disclosure, and do you think there should be a change made by the SEC to require such disclosure?
I'll go first. We absolutely make a distinction among all the proposals. I think even though it's the biggest group of proposals, as Jim found, they're really all over the map when you look at them. I mean, you can kind of roughly bucket them into various permutations, but they really vary in scope and what they're asking for, what the ask is considerably. So we really look at individually what each proposal is seeking. Now, for the most part, many companies already do a pretty good job of disclosing their political contributions. So where we do see proposals, I think our recommendation in favor has really fallen over the years to less than half of them. I think it's 40% so far this year. Because for the most part, even the companies that are being targeted with these proposals are already doing a fairly good job of disclosing this information. I think we do see a distinction between the lobbying, and the lobbying information is available often in the Senate's website, right? So that information is public. I mean, would it be better if the company had it on their own website? Yes, of course. I mean, we're always pushing for more information, but I think one of the challenges is trying to compare companies, and we think that's relevant to try to get a sense of if one company's doing something, how do their peers match up? And that may be where more SEC-mandated solution may be helpful for all investors to get an easy, comparable means to make comparisons across companies in a certain industry.
Okay. And Kent, how do you feel about the distinction between the political spending and lobbying? And do you think that it should be mandated by the SEC, or is that up to each company to disclose, as they see fit?
We believe it should be up to the companies to determine how they disclose it. But there are obviously some companies which are much better about disclosure than others. So when it comes to a political spending proposal, we make a judgment on an individual case as to whether it's reasonable, whether perhaps all it really does is duplicate something the company's already doing. Is the company's disclosure really weak, and therefore is some consideration of that merited? But the recommendation may come out very differently depending on how the proposal is. I agree with Bob that these political spending and lobbying proposals are all over the map. They may fall into those two easy categories, but in fact you have to look at all the myriad subcategories, which we try to do.
Okay, thank you. The Chamber of Commerce has requested the SEC institute a regulation of some type of regulation of proxy advisory firms, and the Wall Street Journal recently had an op-ed calling for modifying government-mandated fiduciary voting requirements of institutions. What is your opinion of that, and do you think that, particularly for smaller institutions that don't have in-house proxy voting departments, what do you think about that? I mean, is it worthwhile for a change to be made so that smaller institutions would be required to vote on, say, for instance, change in control type proposals, and not necessarily every proposal that comes down the pike, and so that they feel obligated to do their due diligence and hire, maybe this is a loaded question, and hire an outside advisory firm to assist them in doing this analysis? What do you think about that?
Well, my initial thought is it reads like a headline from The Onion. Chamber calls for more regulation. You sort of scratch your head like, never seen this before. I think it's interesting. I think the Chamber obviously represent corporations who are going to be obviously critics of advisors who they feel have excessive power or directing some of the voting, and I suppose it's natural that they would want some oversight. I think, if you look at the various oversight attempts, there's been some push to have advisors register as investment advisor. Now, I know EganJones is and ISS is. That hasn't resolved the criticism leveled at some of us that we have conflicts, that our quality isn't what it should be, or we're not willing to engage. So that sort of off-the-shelf solution just doesn't work. And we all have different business models, and from our business model, none of what we do really matches what an investment advisor does. So if that's the form of regulation, we just don't think it would be effective.
Well, maybe it could be some third type of regulation.
Yeah, I mean, we're certainly open to that. We've actually been working quite closely with the proxy advisors in Europe to develop a code of best practices, which we feel will really address all the major issues: conflicts, management and disclosure, quality, engagement, errors, amplifications, all those sort of issues that we think are relevant. That would really be a much more effective way to address the concerns that were really raised in the concept release, which it's been over 3 years now, and in the other releases that various governments from around the world have issued, such as in Canada and in Europe. And the European Securities Market Authority is probably the furthest along in terms of potential regulation, and they've really operated under the idea that a code of best practices where it's comply or explain, that it's a market-based solution, it's not an imposition by a regulator, it allows for more flexibility, particularly for various types of advisors who have different business models. Some will have consulting arms, some don't, some will work, some will provide recommendations, others will not. So there's a lot more business models than sort of you initially may think of when you look at it on a global basis.
Okay. Gary, what's your take on that? I mean, we were talking about how you see a jump in the vote when a recommendation comes out from a proxy advisory firm, and if that is largely due to smaller institutions that aren't, voting based on their in-house guidelines, but have, their voting farmed out to a proxy advisory firm, or wait for that vote recommendation to come out, how do you see the regulation affecting the vote?
I don't think it would affect the vote, but I think it would be more transparent if a corporation knew that a proxy advisory firm, for instance, had control of 7% of their voting shares or 12% of their voting shares. So if proxy voting is considered an asset, and money managers who manage more than $100 million worth of assets need to file a Form 13F that not only discloses the number of shares they have and dollar amount of those shares in a particular company. They also need to disclose what their voting authority is, sold, shared, and none. I don't know. I don't know if that would help anyone. It would be more transparent if ISS or Glass Lewis or EganJones said, listen, between the three of us, we control 25% of your stock. Maybe that would help. I just don't know if that would really get to the...
But we actually control 0% of anybody's stock. And the problem is if an institution is following our recommendations, I mean, to be blunt, it's not our fault, right? I mean, and they may be doing it for very good reasons, but you're sort of shooting the messenger by trying to regulate the advisors. And if your problem was with the voting, then you should focus on the voters. And I think a lot of this is a backhand away against shareholders. And I think that is a very transparent aspect of a lot of this discussion and potential regulation, as there's too much shareholders' rights, and all these directors being unseated and all these CMPs are being defeated. So we have, 3,000 votes on CMP, 50 or 60 were defeated every year. The number of directors who don't get a majority vote is averaged around 50 or 60 last 3 or 4 years since we have CMP. So the number of times that companies are losing a vote is really, really small. So I think this concern is tremendously overblown.
I'd like to say something too,
Sure.
Peggy, if I may. I don't feel that any additional regulation should be required of proxy advisory firms.
Okay.
We happen to be regulated differently than ISS is. We're rated under as part of an NRSRO. Our parent, EganJones Ratings Co., is a nationally statistic. Let's see. Help me out, Sean. Nationally recognized statistical rating organization. Exactly.
Rolls off the tongue.
What he said.
Yeah, it took the words right out of my mouth. But additional regulation, I don't see serves any purpose, and so I agree with what Robert just said. I wonder too, is it possible for me to go back to a point that I was making earlier and expand a little bit on it for 2 minutes? A perfect example during this past proxy season of what I meant by our concern with shareholder value and the way we came out differently from other proxy advisors was in the vote for the vote which attempted to separate the roles of chairman and CEO at Chase Manhattan, at J.P. Morgan Chase. In our view, that was a perfect case of the drums beating for something that to us didn't make sense in terms of shareholder value. J.P. Morgan Chase wasn't without any problems. The white whale matter is still in the news. But relative to the entire banking corporation, it was a very small piece. And in our view, to be so presumptuous as to think that an outstanding chief executive officer like Jamie Dimon should be overseen by somebody else, a move, by the way, which, who knows, might have caused him to move to another bank. But in any case, we felt that that was a clear-cut case of where the roles shouldn't be separated. There are, of course, more extreme cases where they should be, but they're individual. And we think that that's a terribly important point to make. We were joined, by the way, in that opinion about the separation of Jamie Dimon's roles by a number of high-profile, very successful investors, Warren Buffett among them, if you recall, who didn't feel that he should lose both roles. It's also notable that in the end, the votes that carried the day for the company with respect to that were even more in favor of the company's position than had been a similar vote the prior year.
That's true. Jim, did you want to say something?
Sure, and I've written on this specifically, as well as I'm obviously interested in the policy and regulatory topic. I mean, that's what I do. I do the policy side. I mean, I didn't take an express position on what the vote should be at J.P. Morgan Chase. I don't hold shares in that company, but I did note that it was, I thought, strange to target that company given the dramatically better share price performance that J.P. Morgan Chase had witnessed under Jamie Dimon's tenure than the core competitors, Citigroup and Bank of America. So I thought it was an odd target, notwithstanding the fact that the London trading thing obviously gave some juice to the idea from the folks pushing that. On the broader topic, yeah, I don't know what the regulatory answer here is, and I would have an instinctive aversion toward significant regulatory control from the federal level over shareholder voting for a variety of, I think, self-evident reasons. I mean, we don't want our government interfering with substantive voting at corporations, and so anything that went along those lines would obviously trouble me greatly. The flip side is, though, I do think that there's, to some degree, a broken market here, and it's a broken market in terms of the way this shareholder proposal process and the votes on it is functioning. I think it's curious that the company, that the institutional investors that have to compete for investor dollars, by and large, don't introduce shareholder proposals at all. About 1% of all shareholder proposals. Those who do are those who have an express purpose beyond share price maximization, and those who have captive funds, which are what all pension funds are. They're captive funds. They're not competing for dollars the way a mutual fund or a hedge fund is in the marketplace. That in and of itself, just at a meta level, suggests to me a significant problem here. And then the flip side is, if we can show empirically, and the percentage may vary, but it's significant, that ISS, a single company with 600 employees in Rockville, Maryland, with $100 million in revenues and $10 million in profits, is effectively acting as a 15% shareholder in the total stock market. There's something wrong there. And the problem has to be, to some degree, the sort of disconnect between the incentives that investors face. And the investors, the institutional investors, are competing for dollars, and they're competing for competitive advantage. And the incentives that these proxy advisors face and the way they're valued. I mean, I would argue if there's only 100 million in revenues at a firm with 2/3 market share, what they're providing isn't that valued given the size of the total stock market. The reason is, for each individual investor is not going to improve its share return much by being a quote-unquote more informed voter. But they're told they have to cast a fiduciary vote. So that, in combination with a couple of changes, both the shift from individual share ownership that Gary talked about in the 80s toward more institutional ownership overall, and what I would call effectively the disempowering of the individual investor to some degree based on the way brokers can cast votes for individual shareholders, means that there's been a concentration in power with these institutional investors that are forced to cast fiduciary votes, and yet a lot of them don't want to spend any money on it. So they do it on the cheap by hiring a proxy advisory firm, and they don't pay them a lot of money because we know how much money ISS makes. It's part of a public company. That, I think, it indicates a problem. And I think the way we think about fiduciary obligations on the institutional investors has to be in play. We have to think about, they have to have the option probably not to cast votes, which ironically could have the role of letting these folks that care about it. And the reason the proxy advisors are different on average from the median shareholder casting a vote is precisely because of the input they're getting from their institutional investor clients. And the institutional investor clients that care about this are those that care about things other than share value, social investors, by and large, or those that have captive funds. And the reason for that is the reason I can say that is because the other institutional investors just don't introduce proposals at all.
Right.
And so they may care, and I'm not saying that they don't care about something like a board declassification proposal. I mean, they clearly vote for them sometimes. I'm not saying that they think the entire process of shareholder voting and shareholder proposal introduction is wrong and ought to be jettisoned. But I do think that there's a significant problem with this market, and that's the sort of problem that normally would engender a legislative, statutory, regulatory, policy type response, whatever that is. And that doesn't necessarily mean oversight over the proxy advisors themselves, because I totally agree with Bob. It's not fair to beat up on these guys from voicing an opinion and then, if our client just follows us blindly, you can't blame them for that. It's not their fault at all. And I do think they're trying their best to do what they think is right as they define it. So,
thanks, Jim. Just one comment. Having worked at an institutional investor for 9 years, I think many times the reason that a large institutional investor doesn't submit share proposals is they don't need to. You know, if BlackRock or Fidelity or Vanguard is unhappy with a company or is seeking more information, they get management's attention. If you're a small, you know, municipal pension plan, you know, Denver City, something like that, you don't have that many shares, you're an indexer, the company knows that, they may be less willing to talk to you. But if you're a large institutional investor with a significant number of shares, the company will talk to you. So I think that's part of one big countervailing aspect of why they don't submit their own proposals. They don't need to. They already have management's attention. And I can't sort of let this opportunity go without commenting on JP Morgan. I think it's, you know, obviously the shareholder vote on the independent chairman fell. But I think what gets underreported was the fact that 3 directors got 40% against them, which is an astronomical rebuke. If you look at the number of directors who don't get a majority vote or get more than 40%, it's a really small number of directors. And I think most shareholders focus their ire on those directors rather than this non-binding proposal. And I think it's very important to keep in mind, and I think it's very underreported.
And those are the directors on the Risk Oversight Committee,
Exactly.
which are, you know, logically linked at least
Absolutely.
to the London Welding.
Right.
Well, thank you very much. So I guess we'd like to open this up for questions. Yes, sir?
I'd like to ask Mr. Copland, if you assume that there is a free market in proxy advisory services, which maybe there isn't, maybe we'll comment on that, even if you posit that what the institutional investors need is a low-cost service to fulfill this fiduciary duty, what exactly is the market dysfunction that calls for regulation?
Well, I think basically, as I described it, I'm not sure how to say it better than I did previously, but where you've got $100 million in revenues supporting an organization that owns 15% of the total stock market in terms of observed voting outcomes, in terms of empirically observed voting outcomes, that to me is a concern. I do think it begs the question as to why there aren't, why is there not a new entrant, an entrant that says I'm a much more pro-management entrant, and I mean, that's possible that there could be a pro-management entrant that could generate significant revenues. I think the difficulty there is that the investors that care most about this, and those are the pension funds and the social investing funds primarily, wield significant power. They pay a lot of, you know, they're big, they pay a lot of money. And so if you were willing to, if you wanted to take that position, even though that's the median investor's position on most of these votes, you'd be walking away from a lot of money on the table. So that's step one in it. But that doesn't mean that step two in it is there's not a lot of money in terms of potential upside. I mean, if you're trying to raise money from a venture capital firm and you're saying, I want to start a new proxy advisory service because these guys, look at it, they're out of step. They're recommending 70% for political spending proposals, 68% for chairman independence, 45% for employment rights, and these are getting between 1% and 3%. 1% and 3% of these are passing when you actually put these votes to shareholders. There's a problem there. We want to be a competitor. Well, and they say, well, you know, I was a McKinsey consultant in a former life. You say, well, let's size this market up. How much money's on the table? Well, you've got 2/3 market share, you get $10 million a year in profits. You're not going to get a lot of VC money for that type of opportunity here. I mean, at the end of the day, I think these firms would exist absent government-mandated fiduciary obligations to vote, but I think they'd look very different, and they still wouldn't be worth a lot of money. And the reason they wouldn't be worth a lot of money is that your ability to compete for investor dollars as a private investor, a hedge fund or a mutual fund, is completely going to be a function of what your returns look like. Investors are going to say, what's your philosophy? Are you value or growth? Are you small cap or large cap? And what do your returns look like over time? And if, in fact, the vast majority of shareholder proposal voting is not related to share return, you're not going to invest a lot in it. And even if some of these shareholder proposals are related to share return, and some of them clearly are when things like board declassification are passing at 80-some-odd% rates, you're not going to gain an advantage over your competitor funds by being a more informed voter. It's the same problem that exists in voting in large elections. Why is voter ignorance rampant? It's not a function of people not being smart enough. It's a fact that when you go vote, in any large election, your vote is effectively irrelevant. I mean, what Florida in 2000 told us, it wasn't that every vote counts. It's that in a close, large election, the margin of error exceeds the margin of victory. That's true for most investors, with the caveat that some of these larger investors, the BlackRocks, the Fidelities, they actually own enough percentage that it probably does make sense for them to pay attention to it. And they do their own analysis because they might tip the balance in some of these close votes. But for your average small institutional investor out there, it just doesn't make sense for them to invest in this. So I think it's kind of broken, and I think the reason the market exists in the way it does is because of the government regulation. I don't know what the answer is to fix that, but I think something needs to be considered by people who are looking at this market.
Thank you. Any other questions? No? Okay. Well, thank you very much.
I want to thank everyone for coming and all our participants for doing such an outstanding job. Those of you who want CLE credit, do sign out on the way out and get your evaluation forms because we need to have them. Thanks.
Thank you.
I think it is clear how fortunate we are to believe in the power of ideas.
Supply the common sense and the fresh thinking of the Manhattan Institute.